Good morning and welcome to the 12th edition of the UAE Energy Forum, where we're tackling all the areas of where oil and money come together. And the title of this session, this international finance panel, is looking at this issue as to where these two are perhaps diverging. Energy and investment, as we call it, mind the gap. What we're calling irresponsible capital versus responsible capital. Big language, sounds kind of nasty, but isn't intended to be, but to highlight that capital comes in different colors and shades. And as the major oil producers, the international oil companies, back away from investing into hydrocarbons, it leaves a space for other actors to come in. We want to start our conversation today looking at that. And we're delighted to be joined by Dr. Edward Morse, Managing Director, Global Head of Commodities Research at Citi. Welcome, Ed.
I'm glad to be with you, even if virtually.
Well, it's a great to have your thoughts and insights, particularly at the beginning of this year, 2022, where it gives us all a chance to be somewhat crystal ball gazing without the responsibility, perhaps, of being right so early in the year. But Ed, let's just kick off with the headline here. This idea that irresponsible capital will come into the space where responsible capital is leaving. The great experience of the big project managers of Shell and ExxonMobil stepping back from frontline exploration and production of hydrocarbons, leaving less competent, capable capital to come in its way. Your thoughts of that as a theme, as a concept?
Well, I actually think the theme is a little bit overstated. And I think that it is misguided in certain significant respects. So as I look at the so-called super majors, I think they're taking a careful look at what they're doing. But I notice that they are expending much more capital in various places where the return looks like it will come in quickly. That includes Brazil, it includes Guyana and Suriname, it includes other places around the world, and it even includes the United States. But I think the big missing point in all of this is the enormous increase in the efficiency of capital over the past decade. And let me put some numbers on it. So we had in 2014, in at least nominal terms, a record amount of capital being spent on the upstream in finding and developing oil and gas. It was around something just north of 850 billion nominal US dollars in US dollar terms. And this past year, with the pandemic and everything else, that number went down to 350 billion US dollars. The expectations are by the people who've done these surveys that capital spending is going to grow in the upstream by 20%, 2022 versus 2021. That would bring it north of $400 billion. 400 billion is an important number. If we look at the 850 billion in 2014, coming at the end of a dramatic period of time when the cost of finding and developing oil was going up, and then it dramatically fell. At that 2014 point, we're at the tail end of an increase in finding and development costs, which in the period of the decade, 2003 to 2013, those average for the world as a whole went from $6.50 a barrel to $30 a barrel. And in the period between 2014 and 2019, just before the pandemic actually took over, finding and developing costs fell precipitously by more than 2/3. So that $30 a barrel on a 3-year moving average into 2013 and 14 fell to $13 a barrel. So the efficiency of capital has really increased dramatically. And we saw that when we had OPEC plus countries, even before the pandemic took over, trying to rebalance the market because there was just too much being spent in finding and developing too much oil, and they lost market share in their effort to boost prices. So I'm not all that enamored by responsible and irresponsible capital. I understand what it means, even
well,
if we
take the some of the examples, the idea that, for example, we've had recent reports of Halliburton maybe taking over ExxonMobil's concession in Iraq. We had Vitol, the oil trading company, buy up assets in the Permian Basin. We've had other examples of sort of new actors coming more and more, private equity into the shale play for many years and now backing away dramatically, seeming quite sensitive to the risk profile there, or the lack of return perhaps on capital. But our banks like Citi and other more traditional lenders of capital comfortable with new actors taking on these huge projects which require massive HSE responsibilities?
Really depends on the nature of the deal. So let's look at Iraq, where they had service contracts. The service contracts were tempting to companies when Iraq opened up, but they weren't enough. And there's been a lot of politics involved in what the nature of those contracts should be. So we're seeing companies withdrawing from Iraq, and the one you mentioned is not by any means the only one. And in that case, it's being replaced by a traditional service provider that's comfortable with the service contract, and banks are comfortable with that kind of structure. If we look at some of the things that you're talking about with what are nominally known as trading houses, going into the upstream and replacing more traditional exploration and production companies, the question really is, what are they doing it for, and how are they doing it? And is this the first time they're doing it? Well, it's certainly not the first time they're doing it. These companies have been, particularly in the US, particularly aggressive at marketing both shale oil and shale gas. They've done so because of the great advantage they have in buying feedstock, natural gas on a Henry Hub basis, which is kind of locked in. Yes, the more the US exports of LNG, the more it's influenced by the global price, but there's a cap on how much the US can export. And therefore, as long as the US is growing its production base, which it surely is at the moment, this makes a lot of sense for the right type of company. Banks are being more cautious. There's no doubt that banks are being more cautious about the deep water. There's no doubt that banks are being more cautious about the Arctic. But what is responsible and irresponsible changes its color from day to day. And I would just note that in Europe, the Financial Times has reported in recent days, the European Union is thinking of backing away from all fossil fuels are dirty and thinking that the energy transition can happen without there being more natural gas used in the power generating system of Europe. They are now paying the price of not being careful enough about the resilience and the redundancy of the fuel mix. And they're paying record levels of all time for electricity this current winter, and they don't want to do it again. So they may have been a little bit, too responsible, as it were, in moving to green too quickly. And their major supplier, Russia, doesn't want to engage in anything other than contracted natural gas sales, which requires, them saying, hey, we're just going to buy it when we need it, and we're not going to provide a contract basis for making sure that there's a steady, reliable, resilient supply to back up our efforts to go green.
Next thing you know, there'll be a second pipeline from Russia to China, I would think, if that was to be the consistent position of Europe. But we do seem to have come out of COP26 at the end of November with this sort of conflicted posture of, is the transition a cliff edge, or is it a kind of a smooth roll down into a transition into a new kind of fuel mix or carbon management? What's your own sense as we stand at the beginning of 2022, this conflicting sort of optics, if you like, which of course does have a big impact on the sensitivity of money coming into an investment? Why would I buy a combustible engine car if I can't sell it to anybody? Why would a bank invest in an oil production facility and a new E&P opportunity if that project was to be torpedoed? What is your own thoughts on that? Cliff edge or transition into something more stable?
Well, I think it's a little bit of both. There's no doubt that COP26 resulted in the foot being pushed to the pedal. The accelerator of capital going into new energy is really remarkable over the course of 2020 and 21. And Glasgow was kind of an important marking point for doing things faster. The foot went down on the accelerator. On the other hand, going from a world that's been based, whose economic growth has been based on cheap hydrocarbons for 150 years, going from that in a 30-year period of transition is not what I would call anything but disruptive. And I think the world is beginning to learn with this first incredibly disruptive episode of the energy transition that it is not clear sailing. It's going to be a very, very difficult period of time. It's going to be a difficult period of time because you can't go there that quickly without having significant disruption, without having significant differences of view, without having significant problems arising in domestic settings. Look at Europeans trying to find ways to pay for electricity prices that are 6 or 7 or 800% higher than they were a year ago. And that's true of businesses no less than residential households. That's not a smooth path. It's going to be very disruptive. It's going to create divisions. And I think we're seeing that the first lesson of the first year of a difficult energy transition is that it's going to be far more disruptive globally, internationally, and domestically than people have been reckoning.
The outcome of COP26 and that sort of strategy cliff edge versus sort of transition, the Saudi energy minister warned, sort of a cuckoo in the coal mine kind of warning that this strategy, if continued, could result in as much as a 30% decline, 30 million barrels of oil, global oil supply disappearing by 2030. That seemed rather dramatic, a headline, and he certainly is good at sort of making a point in that way. But I'm wondering, from your perspective, how worst case scenario is that kind of outlook, or is there a sort of tangible pathway that we're on to get there?
I think there's a pathway, and I think it'll be rough. So I think the statement on 30% decline by 2030 in traditional dirty oil is incredibly exaggerated. I've heard it from the heads of the IEA progressively over the last 10 plus years, and we've heard it from Saudi ministers, whoever they might have been, and heads of Aramco, whoever they might have been, also over the last 10 plus years, and it hasn't transpired and it's not likely to. There is, however, a difficult thing to try to forecast, and that is the balance between declining demand on the one hand and declining production on the other hand. And that's why I think that this decade and the one after it is going to be fairly difficult, fairly disruptive, and fairly volatile. It's because we can't pinpoint exactly when this transition takes place and whether the transition is accelerating first on the demand side or first on the supply side. And these are subjects of enormous debate. Let's take the demand side alone, where there are those who argue that the world is on the edge of a brand new demand supercycle. History would not tell us that that is the case. If we look at the last 75 years, the world has become significantly less energy intensive in terms of GDP and significantly less oil intensive in terms of GDP. And that history is being, in my mind at least, buttressed by efforts by policymakers around the world to get off of the oil habit. So we have that on the one hand. There are a range of demand projections. Some say that demand does not peak until 2040. Some say demand peaks before 2030. And that's the dilemma, actually. And then we have the arguments on the supply side. And where I started on this was on the efficiency of capital. So while we are free to make forecasts for 2022 at this moment with a bit of impunity, it's our judgment that the range of demand forecasts for 2022 is sort of 3.2, 3.3 million barrels a day, up to maybe 4 million barrels a day. But if we look at the supply side, we have OPEC Plus that is committed to adding another 2.7 million barrels a day. And I say this if they're honest. They're not actually adding 400,000 barrels a day to the market. They're actually adding something more like 260 or 270,000. If they were adding 400,000 barrels a day on their plan, it would be 4 million barrels a day that they're adding to the world this year. And there would be no room for non-OPEC. As we look at non-OPEC, and let me just look at the Western Hemisphere for a minute, not get confused on where Russia stands. In the Western Hemisphere, we have the US growing by 1.4 million barrels a day, and that's just
in
liquids.
22.
In 22, that's just crude oil and natural gas liquids.
Wow.
It doesn't include 400,000 barrels a day of biofuels. It doesn't include the additional volume of higher refinery utilization. And then we have Mexico.
Which just on that point, the US outlook, that nearly brings you back to pre-COVID levels in US production.
It brings us a little bit higher than pre-COVID levels, given that the US has already gotten back to 11.8. So it had been 13 million at the peak, and it was at 10.5 million at the trough. And the Permian Basin is now producing more than it ever has, and it's growing every month with less rigs being utilized in the country as a whole. And then if we look around the Western Hemisphere, Mexico is supposed to be declining. It's going to grow by 100,000 a day, 2021 over 2022. And the rig utilization committed for next year looks like it'll be another 100,000 barrels a day. Add a combination of Canada and Brazil, and that gets us to 500,000 a day between the two of them in a different dimension, both in 2022 and 2023. That doesn't include the 225,000 barrels a day increment from Guyana. It doesn't include little bits and pieces, not as big as Mexico, but big enough in Argentina and Colombia to be noticeable. And then I would just look at the OPEC side, where people had written off Venezuela, saying it was down to 500,000 barrels a day over the summertime. And the Venezuelan government just announced they were hitting 1 million a day. Now, that might be slightly exaggerated, but even the most conservative observer of what was happening in that country would indicate that the production has grown by close to 400,000 barrels a day from September to now. So there's an awful lot coming out of the Western Hemisphere. And I've looked at just the Western Hemisphere and OPEC Plus. There's not enough room in the world for both of these in 2022. So it'll be an interesting patch ahead.
And you didn't even mention Iran, which is a whole nother subject. But I do want to get your views on, we're moving into it would appear, and we could be proven wrong again, but nonetheless, into a tightening monetary policy cycle where money is going to get more expensive, capital will be pulled back a little bit on the central bank side, the Fed, and leading the way globally, at least being the most relevant globally. Your thoughts of how these two issues come together, the return on the investment capital needed to go into hydrocarbons, but at a time in which we're going into a tighter monetary policy cycle. What's the impact and outcome of that?
Sure. So there are two things we have to think about on the cost of finding and developing oil. One certainly is the cost of capital, and the other certainly is the cost of services and the cost of labor. My colleagues in equity research at Citi have just done another of their annual studies called Energy Vision, and they have tackled the issue of cost inflation in what I believe is a sensible way. Yes, labor costs are going up, but the amount of manpower required is going down. Yes, we're having an increase in rig utilization costs, but the productivity of rigs is going up, not down, and they're more than balancing out. So if we just look at the real cost structure of the industry and project some cost inflation going forward, the cost deflation is going to match that. So let's assume, if that's correct, and I think it absolutely is correct, that we're looking at the cost of capital, and we're looking at an increase in bank lending started by Federal Reserve Bank hiking, which my economic colleagues think is going to happen starting in mid-year of this year. We are looking at rate hikes that are going to be important in terms of retarding growth. but how important will they be in terms of lending activity if the addition to the cost structure is going to be, as we look at it, total cost increase, adding about 1.5 to 2% of the cost structure of finding and developing oil. If that's the case, then it's going to have very limited impact on what I was just talking about, the amount of oil that can be readily produced at a profit, because the cost structure of the industry has flattened out. We're no longer in a cost curve environment in which the next incremental barrel is going to be significantly more expensive. If we look at the cost of where we are seeing increases in a national oil company investments, certainly Saudi Arabia, certainly the UAE, certainly in the case of Russia, where capital spending has gone up significantly in the fourth quarter over what it had been any time before that. We are looking at a significant amount of low-cost fossil fuels, and I would include in this the offshore oil in the Caribbean or the Gulf of Mexico, the offshore of Brazil, the onshore
Guyana?
of Canada, and I said the Caribbean kind of sort of, which is where Guyana is. So,
yes, of course.
Maybe if we have a 3-to-1 ratio between where fair market value is to make a profit and where the costs are, I had mentioned $13 a barrel. That's really consistent with $40 oil. If we go from $13 to $15 a barrel, that's consistent with $45 oil. I think the world is in a situation in which there is a danger of overstating the lost production from lower capital spending. And one should be doing more careful homework on what the relationship is between the cost structure of the industry on a truly global basis and what the likelihood is of where demand is going and whether things can be filled. In terms of the dilemma or the uncertainty, I admit that between 2025 and 2030, I don't know whether demand is going to fall faster than supply or whether supply will fall faster than demand. They will both probably be on a downward path. And that's part of really the realistic and disruptive nature and the volatile nature of what the energy transition is likely to be.
Well, in the meantime, we're probably going to see rather elevated crude oil prices. Just to finish off on that point, Ed, what's your outlook for oil prices in 22?
So we think 2022 will end at a much lower level. We've had $75 average Brent for the fourth quarter of 2021. Volatile, albeit, but still it was $75 a barrel, and we think it'll be in the low $60 range by the fourth quarter of 2022. So that's our prognostication. We think that the world is in, after 6 or 7 quarters of solid draws of inventory, quarter after quarter, that starting at least by the second quarter, we're going to see inventory builds for the rest of 2022.
So you're saying over the progression of the year, there'll be a decline to finish the year in the 60s, but it will migrate there through the course of the year, which would indicate that maybe an average of around 70s, 60s, or
I think the average is going to be in the 60s and the high level for the year as a whole. Yeah, right. 68 is the number.
68 for the average on Brent for 2022. Well, I'm sure everybody in this neighborhood would grab that and be very happy with it if that was the case, as I think a lot of budgets are kind of centered around that sweet spot. Listen, we'll wrap it up there, Ed. We're obviously would have loved to have you here in Abu Dhabi for the 12th edition of the UAE Energy Forum. We're delighted to have you virtually. Your words are always well received by everybody here, and we look forward to welcoming you in person in due course, sometime in 22, inshallah, as they say. But yeah. Dr. Edward Morse, Managing Director, Global Head of Commodities Research at Citi, thank you.